So this is one of the first of the series of our webinars which we are conducting on structuring your financial goals. And before I get into giving my presentation or going through the process, let me introduce myself. I am Commander Pradeep Agarwal. I am retired from the Navy. I was a pilot in the Navy, and presently I am heading Meri Punji. Now, Meri Punji is a small boutique mutual fund distributor with a focus on meeting the client requirements, because every client needs highest returns at least risk. We try to match these two competing demands so that the client is able, or whoever it is, uh, gets best results out of their investments. So today's webinar is basically how do you structure your financial goals, how you go about it. It is more focused towards youngsters who are starting their journey in the investment world. Remember, one thing in investments is it is a game of patience rather than a game of knowledge. Knowledge plays about 20% role. It's patience which plays a greater role in it. So Benjamin Franklin had said, failing to plan is planning to fail. And this holds true for everything that is there. And same it happens in financial planning also. So let's look at it. What is financial planning all about? Okay, now in everybody's life, I have said this as segments of plan rather than phases of plan, because everything happens, things are happening simultaneously. They keep happening. All these four things will happen simultaneously, and they do not follow a chronological order. As a youngster, you start earning. The first and the most important part when you start earning is protecting. I will get into what I mean by protecting at a little later stage on this. Basically, it means protecting you, the earner, protecting your assets, your liabilities, which arise out of different times in your life, so that your family is not burdened, and your assets like car, house, everything that you need to protect. It's a very important part of a financial plan that you have protection well in place, because if you're not well protected, it may be such a drain on your complete plan that it may come to naught. Saving and investing is what we are talking about. And at the end, why are you doing all this is to reap benefits out of this, so that towards later part of your life, you are well financially secure and you are able to enjoy life without working, or working at pleasure rather than working out of necessity. So these are the four pillars or four segments of a financial plan which one should be doing. Earning is something which I'm not going to dwell upon, because that is individual's way of going about things, but I'm going to dwell upon on the two main parts, because reaping is towards the end of it, the end result, which will be later on in one of our webinars. But at the moment, we will be looking briefly on protecting and more on saving and investing. Next. So we have what we call it as a smart plan. Uh, Basically, this is an acronym which has come out of specific. Your plan should be specific. It should be measurable. It should be achievable. It should be relevant to you. And how do you change about your plan? What triggers should make you change your plan or do something like that? So let's look at it one by one. So when I said the first and the foremost is protection. When I talk about protection, it is one is the first thing is to build up a emergency corpus. Nothing is certain in life except for death and taxes. So you don't know your job. You may be sitting in a great job. You may go out of job. There are certain emergencies which come up, which disable, which brings you a gap in your workforce, or for women, it is childbirth, or there are other things which come up where you need to be protected, where your lifestyle doesn't get impacted by any financial changes in your earnings or anything. So protection may, the first thing which comes is your term insurance. Now, term insurance is a plain term insurance which one has to take or one gets to cover the life in case you go away or the earning member goes away. And then from there, the financial burden doesn't fall on the family or other. Let me give you an example which is very relevant to all youngsters. Most of you do is study abroad. Large funds are on education loan. At young age, nobody thinks of taking a life cover because they think the family is not dependent on them. But this loan stands out. If you go away, something else, it falls on your parents or whoever is paid for that, is that. So you need to be protected. I'm just giving one example out of it. There can be many out of this. So protection is that. So term insurance is important. Second is health cover. The inflation of what you call the medical inflation is huge. The costs are huge, and it is a tiny amount you got to pay to get an health cover. Most of the youngsters or everybody thinks that I am covered under my group insurance by my company or any other thing. But remember that those are not constant. You may change your job, you may have a job, you may be without job, you may do something, start your own business. The conditions may change, and then you may not be covered under medical plan. So you need to have your own personal medical plan. Quantums, I'm not talking about protection or in this about what you should be. It's just an idea that you should have your medical plan. Then protecting your assets like car, that's a car insurance. Then there is your house insurance. These are that your travel when you do these. So these are protections which you should be very clear about it, and they should be there. Now, one thing which I said in the beginning is building up a what you call is a emergency fund. Emergency fund is to take care of unforeseen circumstances. It should be about 6 months of your annual expense minimum. It could be up to 1 year. Say, let's say you change job and you don't get a job immediately. You should have so much of money that your lifestyle doesn't get impacted by that, and you have your funds to do. It should cover your EMIs, it should cover your protection plan payments. So nothing changes in your life for at least a year or so if your financial earning capabilities or financial earnings change. And that's a very important part of it. This is something which is non-negotiable in your plan. It should be there. And it is good to have this plan, because once you get into the spiral starts very quickly. When you are financially constrained to do things, then you start doing things which are not required to be done. You may take up a job which is not to your liking because you are desperate to get money. Would have started, you become a startup and an entrepreneur. You may take shortcuts to earn faster or something like that. So this is a must. How much you need it is all your expenses, and how long you need to keep it is, and it should be all your decisions, but it should be in the safest form of investment, which it doesn't get impacted by market conditions or anything. So you are giving up your returns, you're putting your money to in idle, but it's better to have it that way than to move it into something more aggressive, and you find that your plan uh, retirement or the emergency fund is dwindling and then it will be again troublesome. Then basically your plans are short term and long term. Uh, it may be too early to think about retirement, which is about 30 years away, 20 years away, 40 years away, but long term is something. Why you should have this plan is that if you save little now, in long term, it can become huge. Like we tell our clients and youngsters that if 10,000 you save for 30 years, every month, if you save 10,000 for 30 years, it amounts to about 3.5 crores. even if you take inflation, and I'm taking at a return of 12% of earnings on your investment, even if you take an inflation of 5%, if the value of money erodes over 30 years, if you take it at 5%, the value of money still will be about 1.5 crores, or between 1.5 crores to 2 crores. So still you have a sufficient, and by no means it is a small amount, 1.5, 1.7 crores, and I'm only talking of 10,000 rupees. You increase it to 20,000, you are double the money. So small savings start early, and if you delay this by 5 years, the the 3.5 becomes 1.9 crores only. The compounding impact, what again, it is the compounding is the eighth wonder of the world, as it's said, and this is what works in the later parts of it. So long term, you should have your retirement, your house buying. I will not get into specifics of anything, uh, uh, anything of it, but I'm just giving you ideas which you can do that. And at the end of this session, we'll have a question answer session where you can ask me anything about it. Short term could be your buying a big financial ticket buy, which you could be lifestyle buys, your travel experiences. Between long and short term, you have your children as you grow in family, your children's educations, children's marriage, and all these things. And I'm talking about Indian context where these five, six things are the financial goals which everybody should have. To start from short term, that is your travel, your big ticket buys like changing your car, upgrading your car, other things. Midterm would be something like your children's educations, what you call marriage, and the end of the year or end of the long term will come buying a house or uh, retirement and all things. Now, every plan should be measurable. It's like if there is no evidence of progress, you are navigating a blind alley. So progress is, how do you check? You follow your plan, you keep measuring it, it is growing. So it will be measurable. If you say, Ki, I want to buy a house, a good big house, it's really not measurable. But you say, Ki, today I like a house for 50 lakhs, which I plan to buy after 30 years or 20 years. At that time, it by cost of inflation, this should be about 1.5 crores. So I should plan to make reach a target of 1.5 crore. Then you have a measurable plan where you know how it is progressing. Otherwise, it will be just what you call a wish, which will have no measure to do it. Achievable. Now, this is something जिसे हम हिंदी में कहते हैं उतने पैर पसारो जितनी चौड़ी चादर, or what you say is achievable. You say कि I earn 1 lakh rupees a month, 12 lakhs, but I want a 50 crore at the end of 30 years. Yes, it may be possible, but it looks unachievable plan. So plan something which is achievable. Huh? And that is very important to how do you plan an achievable plan? You map your cash flows, you select a mix of products, understanding your net worth, all these simple things you have to do. Uh, I will again, like I'm saying, I'm giving you the pointers. I'm not getting into specific, but understand that plan in a way that it is achievable. Relevant. Prioritize relevance. That is important. We all want to travel business class. We all want to stay in seven-star luxury. We all want to own a Mercedes. We want to own a house in BLF, Camellia or something. But is it relevant or is it not? So first in your thing is you decide what is essential. That without this, I cannot survive. This is must. Then there is discretionary. And last is desirable. The desirables should be taken into account at the end of what is left out of your earning. So this is by creating, you make your plan relevant by having a budget. Essentials, discretionary, and desirables. And then separate it out separately and see. Essentials you can't do without it. Discretionary, you would love to have it. Desirables are something you can do without it unless you have extra money to splurge on that. Desirables are basically a splurge. So make it relevant. Now, plan has to be flexible and it has to be very, very what you call I would use the word, matlab, it should be changeable, flexible and changeable. And you should select triggers. When should you bring in changes about your plan? So review and readjust when you have a salary increase, your job changes, your family changes. And that means you get married, children come in or something, or you have windfall receipts as a bonus or as an inheritance or something, then you should be triggering. These are the triggers which you should, at that time, you should review and adjust your plan as you like. When I say job changes, you could be in for a greater job, you could be temporarily out of job, your business earns a lot more money, it's that. And when you achieve a goal, so you have marked it. When you make that, when you under the smart plan, when you make your goals, at that time, if you achieve a goal, then you keep aside that money. Now you say, okay, I have achieved this goal because you had got better returns or because of some other reasons. Then whichever goal is achieved, then the excess which you had planned for it, then reshape the plan of yours. So this is what I call is a simple smart plan. This is what it is. How do you make a plan successful? Like I said in the beginning, it is patience. Every time the market or any investment tests investors' patience, there are no clear cut winners. Winners keep changing. Either you chase returns or you stick to one plan, you will be better off. Like it is said that more money is made by doing nothing than by doing something in times of crisis or something. You just have to write out that. So, and do not change your goalposts very quickly. Don't be swayed or carried away by things so that you start changing goalposts. Other important is systems over willpower. Try and make something which is automated rather than on willpower. Okay, when I earn this, I will do this. I will invest so much. Make automated. Minimum investment should be done. Which instrument you select is a different thing. Calendarize your reviews. Use financial tracking tools so that you know where you are heading. So it is to success a plan is patience and systems over will. I mean, automation is a very important part of this. Why plans fail? And it's a basic, it is universally true. Procrastination is one. I will do it. अच्छा मैं बाद में करता हूँ उस पे है. Goal vagueness, you have not defined your goals. Emotional investing, suddenly you see the market is going up or certain fact the present day everybody is doing is gold and silver they are thinking about. That is not the way to go about it. You have to absolutely rationalize as per your plan and continue with it. You can tweak it little here and there, but don't make large changes. Playing to peer style, everybody is playing his own game in investment. Understand that the risk appetite is different, the risk capacity is different, and that's why it is. So play your own game. Whole lot of people, everybody compares. Yeah, my portfolio is giving 20% return. You think me, my portfolio is only giving 12% returns. What should I do? How do I go about it? I need to change my plan. No, he's playing a different game. He could have been, nobody tells you how long he's been invested. Nobody tells you how much risk he has taken. They only tell you that I'm getting a 20% return. And you think I'm getting 12, you feel a little let down. You either think I need to tweak my plan or change things or have a different approach. Other thing is lifestyle creep. This is a very thing because in this age of social media and everything, you see how people are growing. You see it with your peers. You see your somebody. is earning more. He's your classmate, your course mate, your friend. He has earned a lot more money, or he's doing. You don't know where is he getting his money. He's bought a new house. You are not getting a house. You feel under pressure. He is going on a great holiday. You are not being able to grow on a great holiday. So either you overexpand, you overexpense, you live beyond your means, and this lifestyle catches up, and sometimes it comes back to bite. Don't get into it. Stick to your plan and do. And not keeping in mind inflation. India is a country where inflation has a big impact on your expenses year on year basis. So, what costs 5 rupees today or 100 rupees today, if you have inflation of even 5%, it will be about in 12 to 13 years, it will cost double. So if you're looking at a retirement of after about 35 years, you're looking what you would be spending 100 rupees, you will tend to expand about 800 rupees on that. So that is the kind of inflation you have to do it. So this is what it is very important to keep in mind, the negative impact or the erosion of value of money over in inflation due to inflation. This is you must be hearing this word risk appetite, risk capacity. Now these are two different things. Capacity is how much you can take risk, and that is, let's say a guy who's earning in his 60s or 50s, who's got a house, who's pension planned, who's getting a pension, his children are married, everything is done, and he has a huge corpus and he doesn't. He has a huge risk capacity. Whereas a other person who's there at the same age may not have his house, may not have his children married, he has dependent and different time. So their risk capacity may be low. So risk capacity is a function of what you have and what you do not have, and accordingly you take a risk. Now, appetite is how much you can digest. You may have a high risk capacity, but you may have a low risk appetite. Low risk appetite, when I say ability to weather the risk. Now, tomorrow, like I said, there are no winners in the market. And when there are no continuous winners in the market, or the winners keep rotating, it may happen that your investment is giving negative returns, it is not giving any returns. Would you be able to withstand that risk, high risk, high volatility? Can you digest it and remain safe? Uh, when you ask somebody a question, what will you do if the market falls or your market corrects by 20%? Will you be able to withstand? They will all say, no, no, I am a long term investor and I can withstand. But when you see actually your 1 crore becomes 80 lakhs, you will realize that it's not so easy to do it. So you have to think. So risk capacity is different and appetite is very different from that, because appetite is something, is how much you can stomach the whole volatility of the market. And that's why the market is full of products which will cover each kind of risk appetite. Matching tools to timelines. No investment is a bad investment. It is matter of time. People say equities are a bad investment. I say equities are not a bad investment if you are with, not worried about the time, because it is so important. Just for example, if I'll give you one example of COVID, it was in March 22 when happened. The market dropped by about 40% at that time, from 45,000 of the BSC index to 27,000 or something like that. If somebody needed his money at that time, he would have been in grief because he waited for that time. But if he was not bound by time, and if he had waited for another 7 8 months, if he could have waited for 7 8 months, he would have been absolutely happy because his investments would have completely recovered. So most important thing is time. And time factor decides on what kind of an instrument or investment you should take. Short term, 1 to 3 years, is very low risk. You should be worried about safety of capital over returns and not exposed to market volatility. Markets, you don't know how much time, when will they fall, how much time will they recover. So you have to be very safe. Same way in medium term, you take medium risk, and you need to be monitoring and rebalancing very quickly in medium term, because you are in the cusp where you are able to take a little market or instrument volatility, but you need to be out of that also very quickly, where when the markets turn around or when your goals are achieved. Long term, high growth potential comes from high volatility. Long term is above 6 years. It gives you time to make corrections to your mistake. So if some instrument you have taken a high risk or something which is not doing well, you can do it. You can change the thing. It gives you time to correct your mistakes. So long term should be high risk, high volatility, and high returns. You should take risk. That's why young people should be very much into long term planning and do that and reap the benefits of great returns, rather than being very conservative in their approach about investments. Secure the foundation before building up. I covered this slide earlier. Protect you before investing what you earn. That's emergency fund, pure protection, adequate health cover, and asset protection. I have dealt with in detail, so I'm not going to uh, refocus on this slide. Again, this I've covered part of it. I mean, this is, you will read it everywhere. I'm saying nothing new which is in this. The power of compounding, great. If you getting 12% return, just an example, 12% return, it will double every 6 years. I should, I'm sure all of you would have heard the rule of 72. That is 72 divided by the interest you earn is the number of years you will take to double your money. So 72 divided by 12 is 6. And that is, it will double your money. If you're doubling your money in 6 years, 12 years it becomes 4 times. In 18 years, it becomes 8 times. And in 24 years, it's 16 times. You must have all heard the story of uh, I don't remember who was the king, where when a learned chess player came to him and he said, I'll play a game of chess. And if I defeat your team, who was the best team chess player in that country, I will ask for 1 grain of rice for every square. So there's 64 squares. For first square, 1 grain, next square, 2 grains, third square, 4 grains, and so on that. So the king thought that it's a great move. Even if we lose, I'm going to lose nothing. And then his player lost, the king's player lost, and he realized when he started counting the granary, he could not able to give them that much of rice to that man, because the compounding towards the 60, after 60 or after 50 itself was so huge that the market, the granaries of the king could not master that kind of a wheat or rice, whatever it was. So this is the power of compounding. Patience and discipline. Compounding can only happen when you have patience and discipline. Discipline is the most important part of investing. For all of us, I'm talking majority of us. I'm not talking about people who are born with silver spoon. They don't have to worry about it. But everybody else, if you want to build a lifestyle, you want to have a great life, it is patience and discipline. Time in the market is more important than timing the market. You cannot time the market. Nobody, in the best of the predictions, the best of the analysis, cannot tell you that this is the lowest point of the market or this is the highest point of the market. You can get out now or get in now. Know what you own. Always be aware where you have invested. Understand what you invest. The simplicity of a product is what makes it very, very enduring and very rewarding, because the complexity of the products are more for cocktail circuits to talk about, rather than giving you high returns. They may give you for a little while high returns, but that's not that. and keep margin of safety. Again, it comes back to the same thing, your risk appetite. So your blueprint, the action plan is you got to commit, be smart. You commit to your plan. Whatever plan you make, you commit to it. Calculate, secure, document, and act. The last is then act. Unless you have committed yourself, you have calculated this is what I'm going to do, you have secured yourself, you have documented everything. But if you don't act, it is all come to naught. So please be smart and act. This has come back again. We've done that. Next slide. Next. Next. This is our anybody. We look forward to hearing from you. Before I end and before I start the Q&A, I'll show you one slide which is very important, and I think it will give you an idea. Just hold on for a sec. Just increase the size. Okay. See, the markets are volatile. Everything is volatile. These are some major events which have taken in last 35 years, which have significantly impacted the Indian market. And you can see that 1992, you can see how much the market has corrected by sometimes 43%, sometimes 53%, 56%, 60%, 32. So, and this time, it has been since September 24 that the markets have given no returns. It is testing the patience of every investor which is there. And it is very frustrating at these times. But you remember that whenever these events happened, nobody thought that the market could give such kind of returns as it stands today. So this, despite of such roller coaster ride, the markets have given annualized returns of about 14 to 14.5%. But you have to remain in trend. So I said patience and discipline. So short-term stories will impact the market, and they may impact for a long time. You can say it has taken 2 years, sometimes 9 months. Generally, it's 9 months to a year when the markets recover. Sometimes it's taken 2 years, but it is always there. In 35 years, data is here. I have finished with my small presentation or small webinar. I have used no data. I have spoken on things which one needs to keep in mind. The next webinar when we conduct will be more specific to things, and depending on your question answer, we will be able to structure our next webinar in more matter, which will more be answering your answers in more detail. So I'm open to now question answers. Huh? So at the moment you are muted, everybody. If you raise your hand on the screen, we will be able to unmute that person, and we will able to ask. You can have your question there. Alok. Alok, you can unmute and ask a question.
सर एक तो आपका जो व्यू है वो लेफ्ट साइड पे क्यों आ रहा है?
इसलिए आ रहा है क्योंकि मैं थोड़ा टेढ़ बैठा हूं.
You are not looking towards the screen. और जो सर ये आपने 8 to 9 months की रिकवरी टाइम दी, मैं थोड़ा सा लेट ज्वाइन किया, सॉरी. 8 to 9 months का जो ये रिकवरी टाइम दिया, और इस बार जैसे गोल्ड एंड सिल्वर, तो क्या आपके हिसाब से व्हाट डू यू थिंक कि शुड वी कंटिन्यू टू इन्वेस्ट इन द म्यूचुअल फंड मिक्स, मतलब कोई भी लाइक मिड कैप, स्मॉल कैप, or should we discontinue the funds for some times?
This sometime is a big question, Alok. What is this sometime? The market, the way gold
Sometimes
and silver have gone.
our market makes a bottom.
So how do I time the market? Nobody knows. It is always on hindsight when one knows the market has made the bottom. When market is falling, it's like a falling knife. You don't know how to catch it.
But like a index benchmark, in the last 1 year, the index is on the same level.
That's correct.
So there is no appreciation growth in the 1 year.
That's correct.
And because of the geopolitical situations and
Uh,
tariff wars and some small wars are going on, like Iraq or Russia, Ukraine.
uh,
So is it a better way to uh, disinvest the mutual funds and keep on a handy when the market goes down, then invest in the market thereafter?
so your question is basically asking of timing the market.
Yes.
There is no no prediction, nobody, no analyst can predict when the markets will bottom out or when the market has topped up. Gold and silver, if you remove last 1.5 year from gold and silver, silver was never in anybody's horizon of investing, not even globally, not even in India. Huh? Same as gold, nobody invested in gold. Everybody bought gold as a jewelry and kept it, and which now looks, on hindsight, again a great investment. Today, the conditions are such that gold and silver have outperformed, beyond the wildest dream of anybody, beyond the wildest dream of any. So that is why everybody is thinking of gold and silver as that. I will get back to my first thing is that you should have had your asset allocation uh, 10 to 15% in gold and silver and continue to hold that. Continue to hold your mutual funds. It is testing your patience. It is testing your patience. It could be next 1 year the gold can continue to rise, silver can continue to rise. Nobody will tell you that this is the thing, what it is. And same it is. If the gold and silver starts falling, they are momentum, they are commodities. Uh, the buyers will disappear, and then there it will be a free fall. Exposure to gold and silver, yes, but limited. Don't get out of your mutual funds because you don't know when will the recovery start. Will it continue to hold this time, or will it continue to give this kind of a placid returns over the next 1 year also?
Okay, sir.
So,
Thank you.
so yeah, yeah, Vishal. No, I thought Shruti has unmuted herself. Vishal, you can unmute if you are asking a question.
Yeah, hi, Pradeep. I have only one question since a lot of, young people are also attending this webinar this time. So what do you suggest in terms of their age group that how they should start investing smartly and what allocation they would like to prefer to have, as if you are saying that we can keep some percentage in commodities, some in mutual funds, maybe whatever. So what's your suggestion on that part? It could be like early 30s, early 40s, early 50s, and all are in the group actually right now.
Yeah, I get your point. It's very clear. That's why I said initially you have to decide yourself your goals. What are you investing for? You're investing for, initially you may be looking for short-term goals, would be a lifestyle events, which could be buying a car or traveling, mid-term and long-term. And accordingly, long-term, you should be fully into equities with a high risk thing. Commodities, everybody should form about 10 to 15% of their portfolio into gold. Silver was never ever a investment vehicle. It has just in last 1 year become such a great vehicle. And narratives have been built around it. Ki China's stock is dwindling, so they are buying more silver. It's growing up, but more of it is also because of short selling by some big people in US, banks and others. That's also a story. When they cover up, they will have to unwind these positions. Then there will be a fall in silver. Now this can happen in 10 days, it can happen in 1 year, nobody can say. Silver and gold are commodities. They don't have their intrinsic values. They don't earn money. They are only on demand and supply. They are not on like companies which earn profits. So there will come a time when they will lose their value. But again, the question is when would they lose their value? And 100% people fear with FOMO, or fear of losing out, missing out, and that is what it is driving small investors into gold and silver. Yes, invest a young man of 30 years should keep for short term. He should be in equities about 70% or 80% should be equities, which should be out of which should be aggressive equities, should be about 50 to 60%. 20 should be in more secure funds like the large caps and other things, and 10 to 15% into uh, uh, at the moment into gold. I would suggest a better thing to do with this is like you have multi-asset fund, which at the end of it, as an investor, what you should be looking is what you can do hands-off investment. There are funds which are available which invest in variety of instruments, and that will give you the flexibility. The fund manager with all his resources, with all his research, can be able to do things in a far better than us or individuals who would like to invest in all the products across the board.
Okay, thank you. Thank you.
How do you get the bottom? Yes. How do you? Anybody else? Any questions? Unmute them. So we're going to unmute everybody, and if somebody is finding where to raise their hand from or something, they can just speak and ask a question. Okay, gentlemen, I have finished with it. And since there are no questions, thank you for your time and attendance. And we'll get back with more details in our next webinar. And we will share our content details via email.
Thank you, Pradeep. Thank you. Thank you so much. Thank you.
Thank you. Well.